I'd like to introduce our guest for today, Malcolm Polley, Chartered Financial Analyst with Stratos Investment Management. Malcolm, please tell us about yourself and about Stratos Investment Management.
Thank you, Michelle. As Michelle said, my name is Malcolm Polley. I'm a CFA charter holder, and I am Director of Strategic Market Analysis for Stratos Investment Management. What that basically means is I look at the markets and try and figure out what's going on, and then I write a bunch of things and push it out so that Michelle can use it with all of you and people that she thinks might find some interest of it. I've had the good fortune of having started in the investment business on Black Monday, 1987. And you might not think that was such good fortune, but it's been essentially straight up since then. So it's been a great time to get in the market. It's always also afforded me the opportunity to see, including that, three of the largest market dislocations in history, including the 87 crash, the 2000 to 2002 market, bear market, and then the Great Recession from 2008, 2009. It's been a lot of fun. I've learned a lot of things, and I try and pass those learnings on to people because I really enjoy looking at what's happened and trying to make sense of it and then passing that on to you. So I'm old, and that hopefully that gives me a little bit more information or a little bit more useful information than those that have just gotten into the market in the last couple of years.
Okay, well, thank you. And I feel, bonded to you because I too started at a time of what could be perceived as crisis. Mm-hmm. I started my career in 2001. Mm-hmm. And, a few things happened in 2001, some pretty major things. And I have always thought of that as, while tragic, a gift for my clients because essentially I learned in a time where people were afraid and a time of uncertainty, et cetera. And then, of course, like yourself, went through 2001, went through, that downturn period, the tech bubble bursting, went through 2008, the Great Recession, as well as other periods that have followed, like COVID and so on. And I've always found that to be really helpful as we navigate the next thing, because there's always something different, which is another reason why when folks are like, oh, well, things are going to drop. I'm like, they're always going to drop. Like at some point, they're also going to go up if history's any guidance. So there's any guide. There's really no perfect way to predict what's going to happen when. However, I'm going to put you on the spot a little bit and just ask you, as you said, this is all about sharing your knowledge, et cetera. And you have extensive knowledge. You've been in the industry for quite a while. And tell us about that, because people are asking me, oh, well, the market's going to go down. Maybe they like who's in power. Maybe they don't. One way or the other, I'm like, oh, I think these policies are going to cause this or that or, different things. And my whole thing is always, well, the market tends to, if history's any guide, it goes up and down, but more up than down. And we are going to have a downturn at some point in time. But let me listen to you because this is your whole world.
Yeah, I mean, it's interesting. Even though 2025 turned out to be a really good year from a market perspective, and it's the third year in a row we've had double-digit positive returns in equities, we also had a 20% downward move. And from a market perspective, 20% is the definition of a bear market. Now, my definition is a little different from that. It's not simply down 20%. It's also length, because what a bear market tends to do is it tends to cause investors to forget about the good times that you had, and it brings fear into the market. And odd as it may seem, fear is a healthy thing. Where we had danger in 2000 to 2002 was the fact that, and I know this because I did the survey, investors expected returns from equities to be 20%. And that's just not supported by history. Over the long term, and I'm talking about, 100, 150 years, equities or large cap equities have provided roughly a 10 to 12% annualized rate of return based on the period of time you're looking at. And to get that period, that 10 to 12% rate of return, you will experience periods where the markets are off 5%, 10%, 20% or more. And my career has encompassed at least two, actually three periods of time where the market was down more than 50%. Now, it didn't take much to get that market to come back up to where we were before, but the markets do go down very substantially. And what I have learned over time is that it's not so much how much you win as the markets go up. It's how much you hold on to when they go down. So, not putting all of your eggs into one basket, understanding kind of what the impact is of various changes on the market, and taking steps to make sure you're in a good place when things don't turn out so well, as they will over time, is as important as being in the right places when the markets are just going up.
I couldn't agree more. I mean, risk management is a key part of a solid financial plan.
Right.
And when I'm building my financial plans and when Nancy and I are working on them, one of the things we look at is how the plan does over time, not just in rosy scenarios. That
Right.
Anybody can give you the rose-colored picture,
Right.
but reality is never rose-colored, at least not in my experience.
No.
25 years. So let's talk about that risk management, because it's a key part of financial planning and investment planning. And so one of the reasons that I hired Stratos Investment Management to handle the majority of the investment management for my clients was because, one, you're held to the fiduciary standard, but two, more importantly in some ways, would be that risk management standpoint. And so let's talk about the components of that. And I mean, we don't have to go into the weeds on it, but like, what are the things that are essential to the types of portfolios that I've been utilizing for my clients? And of course, there's a range, because some of these can be customized and things of that nature. But in general, let's talk about those things, because it's important to remind folks.
Right. So, our focus has been, and will be what we like to believe are above average risk-adjusted returns. So it's just doesn't mean up for up's sake. It's making sure you're not getting too far out into left field and getting ahead of what might happen from a market perspective. That might mean, don't load up on AI or technology when it represents 40% of the market. Probably makes sense. We had said at the beginning of last year that we thought that the Magnificent Seven, and those are the big seven names that really were moving forward and moving forward quite a bit in 2023 and 2022, that the Mag 7 probably weren't going to have their day in the sun in 25. And it made sense to focus on the other 493 stocks. And in fact, if you look at what happened, the best performing Magnificent Seven stock was in 28th place. They were the 28th best performing stock in the S&P 500. The worst performing was still positive, but was only up 5%. And this is in a year when the top 10 names averaged right around 100% return. So, the Mag 7, while they did reasonably well as a whole, did not as well as the market. And in fact, if you look at the average stock, I believe it's only six of the seven stocks did as well as the S&P 500. If you look at the median stock, which is kind of the halfway point, I think it's only 5 of the 7 did as well as the mean return for the S&P 500. So, it really did make sense to focus on things that had not run quite as far and as hard as the Magnificent Seven stocks did. We really think, and that's kind of what we focus on. We're not looking at what did best last month, last quarter, last year, because that probably isn't going to be the best performer in the next month, next quarter, next year. And so we want to make sure that we're always, or hopefully, moving forward and reducing the risk that a portfolio is exposed to. People spend far too much time being exposed, looking for return. They don't spend near enough time making sure that they're getting paid for the return that they get, which is paying attention to the risk. And that's really kind of built into SIM's DNA.
Okay, so Stratos Investment Management, aka SIM, is really focused on not looking at past performance, which is no guarantee of future performance, right. But really looking at what is the right mix. And essentially, we're using exchange traded funds, or you're using exchange traded funds to make sure that there's wide exposure to a ton of stocks. So we don't have to worry if one stock implodes or several implode. Right. They're actually a whole ton more. And, in the example that you just gave for the S&P 500, that's important because, the winners didn't win as much as they were expected to by the general population.
Yeah, and we put out a piece last summer, I believe it was, where people look at they view the market as the S&P 500. So the S&P 500 should provide quote unquote market risk and market return. And I'm going to apologize for getting a bit wonky, but there is a ratio called beta, which basically measures the risk of an investment, i.e. a stock, relative to the market. Now, the market from an academic standpoint is all investable assets, public and private. And so it is not possible for an individual to invest in the market because there's no way to do that. And so what we have to do is we create a proxy, something that stands in the place of the market. And in most cases, the proxy is pretty good. It's like you can invest in the S&P 500 by not investing in all 500 names. In fact, many index funds do it that way. You can invest in, let's say, just to pick a number out of a hat, 80% of the S&P 500 and get the vast majority of risk and return of the 500 itself. So what we wanted to look at was how much risk are you taking by investing in the S&P 500? Now, the market beta is 1. So if you are investing in an asset that has a market beta, your asset will rise and fall in line with the market. So if the market's up 10%, you'll be up 10. If the market's down 10, you'll be down 10. What we found is that by decomposing, again, apologize for the terminology, or taking apart the S&P 500 and looking at its component parts, it's fairly easy to calculate the beta of the S&P 500 as a portfolio. And what we found is the beta of the S&P 500 was greater than 1.
So it had more risk than
the market, which if you think about it and you think about how it's comprised, as I said earlier, the S&P 500, approximately 40% of the S&P 500 is made up of technology stocks. And that's a lot, in my mind. It's a lot of risk that you're taking for the returns that you're expecting. Actually, it's about a third of the S&P 500 is technology stocks. That's a lot of risk, a lot of exposure to one type of company. And so we want to make sure that the investments that we do don't overexpose you to risk simply for the opportunity of higher returns. Because as I've learned over the 30 plus years of investing, just focusing on returns often causes you to take on a lot more risk than you really want to.
Okay. All right. So if I'm hearing you right, it goes back to diversification.
Exactly.
And that diversification can be gained in a few ways. Yep. One, like even within that asset class, large company stocks, you're looking to try to get the best risk-adjusted return. In other words, not take too much risk for a particular return.
Correct.
And then another thing would be not just the market, which everyone thinks of as, which is the S&P 500, but the markets, because there are different components, small company stocks, both, value and growth. And we could get wonky and go into all the different types, but essentially spreading out the risk and knowing that we can't predict, like you said before, what's going to be the next winner, because last year, even within a particular category, the expected winners or the winners from last year are not the winners from this year, that kind of thing. Right. Okay. All right. Okay. And then, well, let's just talk about some of the other ways that you manage risk. So rebalancing and those types of things. Like, I mean, sometimes you hear people, I had someone say to me relatively recently, it was very surprising because this was somebody who was trying to build and wealth and had not been successful in building wealth and were not my client, and say, oh, well, what you're talking about is 1990s stuff, like diversification and managing risk and so on. I was like, oh my gosh, well, I don't know. It's worked really well for several millionaires that I know. But hey, what do I know? So talk about the other components and whether they're dead or still very much alive.
But diversification is very much alive. The only time that I've found that diversification doesn't work, and we can debate that, is when correlations, or the ability of asset classes to move together, goes to one. And those are really extraordinary times, like, the Great Recession, 2008. The only asset class that worked was cash. Which is fine, but you have to ask yourself if, 2% return is good. In a time when markets are down, 30%, yeah, that's good. But in the vast majority of times, the diversification that you do is going to help you over time. It's interesting. If you look at something called the efficient frontier, I'm assuming that you talk about that with your clients, Michelle.
Yeah, I would say not in great depth, but essentially it's that same thing that we were just talking about, like looking at making sure you're not taking too much risk for a particular return. So I have actually drawn it out for some people, but some of the folks watching this, I might have drawn it out for them a while ago. So it may not be something, but I can always show that as an
attachment. And I bring that up because most people might think that the lowest risk portfolio is a portfolio that's, say, all bonds. And it turns out that if you add even a little bit of stocks to that portfolio, your risk goes down, not up. And the reason that's the case is stocks and bonds tend to move in different directions. And if you think about it, that makes sense. And what you want to make sure that your portfolio, that you're not all exposed to one asset class, so you get at risk to the worst aspects of that asset class.
Yeah, absolutely. Okay. All right. So that what I'm hearing is, it's not dead. Diversification still makes sense.
Yeah.
And it still works over time. In short periods, it may not seem to, but over time, historically speaking, diversification has worked.
Yeah, and in many different flavors. So diversification within asset classes. So let's use that bond example again.
Right.
Had you been invested in the bond market in 2022, what most investors did, and you have to realize the interest rate environment then was basically 0% rates across the time horizon. So whether you're short-term or long-term. And if you looked at it, the probability of having a positive return in 2023 with interest rates at zero was effectively zero. You were probably going to lose money in bonds in 2023, which you did because interest rates rose. The only investment in the fixed income environment at that time that actually didn't lose money was cash. But again, you're talking about an investment that effectively had a zero rate of return. And so you need to ask yourself, okay, how do I diversify within an asset class? You have to understand history. Do you put all of your money in the highest returning vehicle, which tends to be the longest term? Or do you focus on a little bit more money in shorter term where, yeah, your returns might not be quite as big, but you also don't have as big a risk of losing money when interest rates do go up? And one thing we know over time is interest rates go up and down.
That is absolutely correct. I mean, it's funny, you were talking about dating yourself and so on. I feel like 25 years is not nothing, right? And so
No.
I've seen a few things, and I just think about like 2022, for example. That
Mhm.
it's just one of a handful of times, or less than a handful of times, where we saw a situation where essentially both stocks and bonds were down.
Correct.
So
Correct.
it was just it's one of those things. If you stay invested long enough, and if you are an advisor for long enough, you're going to see some things that have only happened a couple other times, or maybe never happened,
Yes.
as time goes on.
Correct.
So let's, before we go to Venezuela, which is something that we haven't seen before, but let's talk. Let's finish out the thought about like the different ways in which we manage risk. So the whole idea of rebalancing. Can you put that in like plain English in a
Yeah.
nutshell and talk about how Stratos Investment Management handles that?
So, in its most basic, there's an old investment saying that says, bulls make money, bears make money, pigs get slaughtered. Okay. Sounds kind of odd, but what it basically means is that as your as certain assets rise, you need to take some money off the table in order so that you're playing with less and less of your money and more of the market's money, so to speak. Um, and so rebalancing does that. It sells some of the winners and reinvests in some of the things that haven't performed as well to try and even out the risk. Because if you just stay invested in the winners, what's happening is that over time the risk profile of your portfolio also rises. And you want to make sure that if you've invested your portfolio to achieve a certain level of risk, that you're not taking more than that risk. So rebalancing allows you to do that. I have had investors say, I don't want to, I don't want to sell the winners because I don't pay taxes. Well, excuse me, would you rather pay taxes or lose 10% of your assets? I'd rather pay the taxes. Yes, it's painful, but it's much better than losing a percentage of your assets, which may happen if you don't rebalance. You may lose the gains that you got.
Right. So again, going back to what you said earlier about, it's not that you're never going to lose, but managing how much you lose is something that is key to the long term
Exactly.
overall outlook of
Exactly.
your portfolio and of your financial life. Okay. All
Exactly.
right. So you mentioned taxes. So let's
Hmm.
talk about tax efficiency. And of course, that only applies with situations where it's a non-retirement account.
Yes.
So what are the things that in non-retirement investment
Hmm.
portfolios that you're doing and I know this, of course, but I think it's helpful in this conversation as we frame everything out
Yeah.
to address this before we go into the questions that I've been getting. Go
Yeah.
ahead.
So the easiest thing to do is sell the losers, right?
Mm-hmm.
If you've got assets that are at a loss and you've got a lot of gains, you can sell the losers to offset the gains that you might take. That's the easiest one. Probably more important, or just as important, is that when you invest in an asset over time, so you invest in ABC fund over time and you've invested every month for 5 years, within that asset, what you will find, even though you might show $10,000 in ABC fund, is there are different cost lots within that investment itself. And that's where it makes sense to perhaps sell the lots, the shares that are actually at a loss, even though your position may be at a gain. Um, that creates a much more tax efficient portfolio because you're not just taking gains when you're selling something. So pay attention to which lots you're selling, particularly if you need some losses to offset gains, right? Um, if you've got an asset at a very large loss, it might make sense to sell that, wait the 30 days, and if you still like it, rebuy it and bank the loss. Okay, so from a tax perspective, if you don't have enough gains to offset the loss, you can carry that loss forward for a period of time. And so banking a loss makes a lot of sense. And we tend to do that in periods of time where the market as a whole is down. You sell and you bank losses so that you can use them in the future, and it protects the portfolio against having to pay gains for a while. Something else you might want to do is, again, that wait 31 days so you don't avoid a wash sale. So if you sell a company stock and then you buy it before 31 days, that's called a wash sale, and your cost basis reverts to the original cost basis. So you've eliminated the benefit of having done it. Paying attention to the time frame of what it is that you're selling. Looking at the difference in tax rates between short-term gains and long-term gains. So long-term gains are taxed at a much lower rate than short-term gains. Short-term gains are taxed at ordinary income rates. So paying attention to the tax rates that you're paying when you do pay taxes is important, or it's called the character of your gains. Those are just some examples, and you can get a lot more creative for different types of clients, but those are the majority of things that we do just as a matter of course.
Absolutely. And I like that it's proactive in terms of the tax loss harvesting, because you're right. Sometimes you could have a bad year, but sometimes it's just a bad month, or a bad, 2 weeks or something like that. And you can take advantage of that and make lemonade out of lemons with that tax loss harvesting, which is what you've been describing, and not just sell everything wholesale, but look at where are the opportunities. And I've definitely, in my 25-year career, had situations where we banked some of those losses, which then helped us to offset gains and rebalance and do some things. So I think those are really, really key things. Okay, so some of the questions that I've been getting, this one it's hot off the presses, the Venezuela one. So I can't say that I've been getting this forever, but if you could speak to, in terms of what this means for folks' portfolios, please, can we talk about this? And I mean, obviously, I can think about some times in history where things have happened that, might be reminiscent of this, but today it feels different.
Yeah, so Venezuela by itself doesn't mean a whole lot. I mean, I hate to say that, but it doesn't mean a whole lot from an investment standpoint. So you think about the areas that might get hurt, energy for one. The reality is Venezuelan oil is heavy, sour crude oil. You have to inject steam into the ground in order to get the stuff out of the ground because it's so thick. The fracking oil companies in the United States that are focused on shale plays actually pump a lot more oil than what we would get from Venezuela. So the fact that you're adding Venezuelan supply to the market really doesn't mean a whole lot. So short term, it doesn't mean a whole lot. From a fiscal standpoint, again, so in hindsight, historically, whenever the United States has gone to war, that's tended to be a good thing for the economy. And why is that? Massive fiscal spending to spend on defense, which gets pushed through the economy. That's classic Keynesian economics. What people forget, though, is it's not the level of spending. It's the increase in the level of spending. So, Venezuela probably would not cause that great a degree of an increase in spending to create a classic fiscal stimulus. So by itself, it probably doesn't mean a whole lot. We can go back to the Reagan years when he invaded Grenada, right? Very small. It ended up being a positive because it was a rationale to spend more on defense. So it turned out to be a fiscal positive, but the budget that we had back then is much smaller relative to the budget that we've got today. And the budget deficit then was dramatically smaller than the budget deficit we've got today. So by itself, it probably doesn't mean a whole lot. Geopolitically, the place to watch is China and Taiwan, because that would be a real issue. And And again, this is my view, and it's shared somewhat, is that we don't think it's an issue this year, but it's something to watch.
Okay. All right. Fair enough. Fair enough. So thank you for sharing that. And I will say that my father is Grenadian. So I
Uh-huh.
have family who's Grenadian, and I have family members who are still alive who went through Grenada. So
Yep,
very different situation in some ways than what's
very much.
happening in Venezuela. But you're right. I have heard that analogy
Mhm.
in listening to the news, and it's probably a lot closer than Iraq or
Yes.
Kuwait, stuff
Yep.
like that. So, okay. So, thank you for giving that perspective. What about the fact that well, not the fact, but sometimes I'm getting questions where folks are like, if they are for the current administration, they're like, hey, we're going to have like a double digit return year, and there's no doubt about it. I could do this on my own, kind of thing. And it's
Hmm.
like, okay. And then conversely, some folks who are not a fan of the current administration thinking, oh, okay, well, with tariffs, even with them calming down and so on, still feel like the policies are not what I agree with. So we're going to go into a recession. Can we
Yeah.
speak about that? Like,
Yeah.
those components, like, the politics, not, in terms of you going into politics, but like,
Yeah.
what does that really mean? Just
Yeah.
because we disagree with the policies. And
So
then also,
so
go
there's
ahead.
two distinct pieces to that. The first one in regards to the Fed and interest rates, double-digit returns. Um, so if you think about how you value any asset, and this is the instructor in me because I've taught at a local university. How do you value any asset? It's simply the present value of all future cash flows, right? So all the cash you might earn from an investment discounted back to present at a specific discount rate. So the key there is the discount rate. Okay. What are you discounting your future earnings to today at? And in general, as rate goes higher, values go down, and as rates drop, values go higher. So and this is my view, and Sim's view to a certain extent, is if you ask yourself why the current administration would like to see interest rates come down, is I really believe that they missed an opportunity the first time around when interest rates were effectively zero. So there were rumblings back then of Treasury and Fed wanting to extend the maturity on the treasuries that they were issuing to fund the debt and the deficit. They could have extended maturities, let's say, to 30 years relative to funding everything short term, and the rate would have been, call it 2.5%. The rate on a 30-year today is 4 plus. So you can't extend maturities because your debt service cost is going to rise. So why does the administration want rates to come down? They want to reduce the debt service cost of the federal debt, which has more than doubled in less than 5 years, from half a trillion to over $1 trillion. That is probably one of the biggest risks to the market over time, is the amount of funding that's going on to fund the national debt and the deficit. And that's true regardless of administration. So it should not be a political issue. It really should be one of, we need to understand what's going on and get behind changing that. Now, structurally, the administration can only deal with the front end of the yield curve. The Federal Reserve only sets rates at the very short end. They can mess around with the longer end by buying securities, which is why, even we believe, Chair Powell at the last Fed meeting said they were going to start buying government securities again, quantitative easing, if you will.
I
Not a
remember
lot
those
was made.
words.
What's that?
I remember that name.
Yeah, and not a
Hmm.
lot was made of that, but that's happening again, and we really believe that is a response to the increase in debt service costs. And as much as the administration would like to lengthen maturity and tie those in, they can't, because the cost is much higher longer term. So tariffs, there are two cases working their way through the Supreme Court. One has been heard and is expecting a decision on. The other has not yet been heard, both questioning the administration's authority under the Constitution for instituting tariffs. Now, my belief is, purely from a direct reading of the Constitution, taxing authority rests with Congress. Period. End of story. and a tariff is a tax. So in every other administration, even though Congress has advocated some of that responsibility to the president to set the tariff in every situation, that those tariffs now have to come back to Congress to be approved. The Trump administration short-circuited that process and never sent those tariffs onto Congress for approval. So my belief and our belief is that in I think it's the IEEA case that was heard, that sometime in the next month or so, the Supreme Court will say, the administration, you exceeded your authority, these tariffs are null and void. And I think that will happen to the second one, because what we have in the Supreme Court today are textualists, which basically means the Constitution means what the Constitution says. Can't read anything else into it. If they say the taxing authority rests with Congress, that's where the authority rests, period. If that happens, there's been about $100 billion in tariffs that have been received. There is a lot of discussion as to whether or not that money is going to have to go back. Okay, that's part of the story. The other one is it's got the interesting name of taco. No, it's not something you eat, although you can eat tacos. This stands for Trump always chickens out.
Okay. Yes, I remember hearing about that.
And if you look at what's happened with tariffs, in every instance where he's been pushed, he's reset them back or said, that's on hold until we talk about it. The most recent one in the journal, which I believe was cabinetry, and I forget what the other thing. So in most instances, the administration has walked back the tariffs that they put in place.
Farms?
Yeah. Mm-hmm. So, tariffs did not have as big an impact on inflation as people feared. And we don't believe they're going to have as big an impact on the economy as they get unwound in the coming year. And we truly believe that they're going to be unwound.
Okay.
It just depends on at what level ultimately. And if the Supreme Court forces their hand, it's going back to what it was before. Okay. So that's kind of the issue with Trump. The interesting thing with this administration, and this is me talking, is that what President Trump has said in general he does, whether or not people agree with him. And that's different from other administrations in that as many of them have floated trial balloons and just let them go.
You have a point. He definitely told us he was going to do these things, right?
Yeah.
Mm-hmm.
And what I think the market is struggling with is, okay, as crazy as some of these things sound, maybe he's going to do them. Maybe he's going to do them. Mm-hmm. And I think he's using the crazy to his advantage.
Okay, so the fact that he's keeping people on their toes.
Yeah. Mm-hmm. You have to take what he says, not with a huge grain of salt, but you have to put it in the back of your mind that he's going to do it, or at least try to do it, with or without Congress's help, and let the court's chips fall where they may.
Okay. All right. Well, that might tell us something about Venezuela as well. Yep. Yep. All right. So moving on to the outlook for 2026, which is what we said this was partially about. But it was really important to talk about these kind of building blocks and things of that nature and current events. So, like I said, it's unfair to put you on the spot, but what's your outlook and Sim's outlook for 2026 of the market?
By and large, reasonably constructive. Yes, this was from an economic perspective. We really believe that we've been experiencing rolling recessions. They hit various sectors of the economy and then they roll through. If you look at the data that typically you look at from a recession, whether it's unemployment rate, job openings, inflation, manufacturing output, productivity, etc. while each of those data points has bumped up against a recessionary signal, none of them have done so yet in concert. So they flash a signal and they move back. The Fed's most recent view is that they're cutting rates because they're concerned about job openings. Well, job openings actually bottomed, it looks like, sometime this summer. And job openings have actually ticked up for 2 or 3 straight months. We're going to get JOLTS data, and we'll see if that continues. But we really believe that we've been experiencing rolling recessions, and those rolling recessions will probably diminish as we get into 2026. We believed last year that the Fed would change their focus from inflation to something else, which they did. We really believe that inflation at 3-ish% is probably okay, because the 2% number was not based in any historic or reality from a data perspective. The long-term average in inflation, depending on which one you choose, is roughly 2.6%, which, guess what? That's about where we're at from an inflation standpoint. And remember, the Fed's mandate is not zero inflation, it's stable inflation.
Right.
Okay. So, we're probably okay from an inflation standpoint. From an unemployment standpoint, a 4.6% was the most recent reading. Unemployment rate is still, in most books, full employment. If it rises, our belief is that it probably tops out around 5%, which is still, from back when I grew up and into this business, 5% would have been considered full employment. There's a demographic backdrop that's probably causing some of these numbers to look a little weirder than they normally would be, and that's because there are not enough Gen Z, Alpha generation to take over for the boomers like me that are retiring. That will work its way through the system over time, but it's time. It takes time, and so I think the economy is going to be okay. It's clear that the bottom third, from a consumer perspective, has had difficulties and probably will continue to have difficulties. But net, the consumer remains strong. And as long as that's the case, the economy will continue to chug along, whether it's 4% growth rate, what we saw in Q3, or if it's going to be something lower than that. But as long as it's positive, it's positive. The market continues to move forward, or the economy continues to move forward. From a market perspective, we don't believe interest rates are going to move meaningfully higher. You're probably going to continue to see the yield curve, and that is the difference between very short and very long-term rates, widen a little bit. We ended the year at about 58 basis points between Fed funds and the 10-year. That could widen out a little bit more, but not so dramatic as to cause returns in bonds to turn negative. So bonds will probably be okay again this year. What that means is also you don't have to worry about the discount rate creating a problem from an equity valuation perspective. And expectations for earnings are pretty constructive for 2026. So, as long as that maintains, then we're reasonably positive on 2026 from an equity perspective. Will international outperform U.S. equities in 26 like they did in 25? Maybe. That really depends on how the dollar does. And as long as the dollar doesn't strengthen relative to international currencies or strengthen meaningfully, because we think earnings are going to be pretty positive internationally, then international probably does okay relative to U.S. securities. The big curiosity in my mind, in our mind, is, will smaller finally turn out to be better than bigger? That was where we missed it last year. We really thought smaller was probably going to be better, and you got double-digit returns, but you underperformed the S&P 500 by a reasonable amount. Smaller, we're hopeful will be a little bit better, and a lot of that depends on the Fed. If the Fed continues to cut rates, then cost of capital for smaller companies drops, which is always good for valuations. But in the main, equities we think will be pretty good in 2026.
Okay, great. Thank you. So something that I get, and this will be one of the last questions, something that I hear a lot because I'm fortunate to have multi-generational situations where, I have sometimes up to three different generations of a family as clients.
Mm-hmm.
And so some of the younger folks are finding it harder
Mm-hmm.
to find employment.
Yep.
And especially being, I'm in the DC metro area, I have clients all over the nation at this point. However, that being said, anecdotally, with
Mm-hmm.
the federal job cuts and the kind of the waves that caused in
Mm-hmm.
employment in this region, it's something that I'm hearing about a lot. So can you speak to that? Because you were talking
Yeah.
about unemployment is only at, I think you said 4.4%. And when we really look at it, I mean, that is very low.
Yeah.
But I'll have people say, oh, but not everybody's reporting, which is true. You hear that from time to
Mm-hmm.
time, but there are people who've just opted out
Yeah.
because they just gave up. So can you speak to that and then put it in the context of really, okay, does it mean that these people have to
Yeah.
move, or like what
Yeah.
are we talking about here?
So I'm going to speak to that last thing you said. People have given up, opted out, and given up. Those people are actually included in the data. So they are not included in the unemployed because in order to be considered unemployed, and this is a characteristic of how the data is defined, you have to be out of work and looking for work. So if you're out of work but no longer looking for work, you're not considered unemployed by the federal government. Okay. Um,
Interesting.
so that, having said that, there are, if you look at the jobs to unemployed ratio, there are once again more jobs available in the United States than unemployed people available to fill them. You can fix that two different ways. You can bring people that have given up and gotten discouraged back into the labor force, which hasn't really started happening too much yet. But when that does, the unemployment rate will actually rise because, again, they're looking for work, so they're not considered unemployed. The unemployment rate by itself doesn't necessarily tell you the health of the labor market, because you can play around with that in various different ways. But demographically, I think that the labor supply is weird. So what I call new to labor market, which is 16 to 24-year-olds, those are the labor pool for first-time jobs, is actually lower today than it was 10 years ago. That's your supply of new labor. And the 55 and above, which is people leaving the labor force, there's actually more of those leaving the labor force than we're bringing in the new to labor. So you've got this structural problem that it's going to exist for a while. And what that means is we've moved from a pure manufacturing economy to what I call a knowledge-based economy. You get some dislocations. So unskilled labor is no longer, and I say this not to be, not to sound mean or anything, but unskilled labor is not desirable labor, not a desirable labor. You need to have skills, whether it could be plumbing, electrician, machinist, what have you. People still have skills. And unskilled labor is going to be automated away. So let's use a retailer as an example. You've got two types of laborers in a retail environment. By and large, you've got the front end checkout person, and you've got the back end stock person. Who's got the higher value add? Well, it's the stock person, because without product on the shelves to buy, you can't bring it to the front to check out. So it shouldn't be a big surprise that we've had an increase in self-check stations, right? Because that checkout person, as nice as they are, is not the higher value added position. It's making sure the shelves are full. So the makeup of the market is going to change and has been shifting dramatically. AI is another area that's going to cause it's beginning to cause a massive shift in labor, and unfortunately, it's going to impact that front end job, right? So I came out of the banking world. the kind of that first entry level position in banking is as a financial analyst, where basically you take financial statements and you spread them and you put numbers into big spreadsheets. All of that stuff can be handled by AI now. You might need a couple of people to make sure the data going in and coming out is accurate, but the reality is you don't need all the people that you needed in order to do that data. You need a higher value add position, which is interpreting that data.
Right.
And so it's going to mean probably some dislocations in the short term as we learn what that means. It means that, college graduates are really going to need to place more emphasis on getting internships because they need to have some experience. Absolutely have to have experience because that's what's going to get you into that next position. And so the labor market itself is going to change, which always means dislocations. We saw it in the 70s, as manufacturing started leaving the United States. Again, you move toward a higher value add position, and it's more efficient, and it means that you as a laborer are more productive, but yes, it means dislocation for other people. And so you're going to have some of those dislocations. So retraining, all that kind of stuff is going to be important. So I would expect to continue to see some labor mismatches. It also means that, if you look through the last 30 years and you look at the sector of the market that never downsized, the only sector that never downsized was government.
Okay.
In the Great Recession, what was the one sector of the economy that actually saw increases? It was government. In COVID, what was the one section of the economy that saw increases? It was the government. If you look through history, government spending in terms of employment has never dropped. And so it was ripe for the reset that has gone through the rest of the economy to date. It's a natural and a good thing to happen to make sure you're efficient. And yeah, it creates dislocations, but it gives you a healthier economy in the long run.
Okay. All right. Thank you. Thank you very much, Malcolm. It's been a great conversation. And if there are other questions that come through, we'll send them your way to get your take on it. But thank you. This has been really great. It'll be interesting this time next year to see whether your outlook thoughts prove to be right or not, but I think overall you took a pretty balanced approach and a historical approach, so I think you're probably relatively safe.
Yep, we hope so anyway. We tend to get direction right. We tend to get magnitude off a little bit.
Right, absolutely. And I think just even talking about that last topic, I heard a couple things that, unskilled, labor is most at risk. But I also heard that people need to upskill because even like for that financial analyst position, which was not unskilled, there has to be a pivoting, a repositioning. And like you said, that can be disconcerting, but we're nothing if we're not adaptive, especially young people. So
exactly.
So that's great. So. Well, thank you so much. And as we have more questions, we'll send them your way. And we'll check in on this at the end of the year, beginning of next year to see how on target you were.
Sounds good.